and you need no introduction, and you have been managing these the funds beautifully, and we all are seeing it day by day. Before we ask, go down to the main topic, the audience out here is really confused. I so there's something called VUCA word, which everybody is talking about, which is volatile, uncertain, complex, and ambiguous. VUCA. That is where we are. 3 days back, market was a different mood. Last 2 days, market is in a different mood, and it is leaving all the clients really perplexed in terms of what exactly is happening. So, Niket,
Yeah.
I just request you to spend some time first on what is happening on the equity market, and obviously how this is progressing. How do you read it?
Yeah, perfect. Thanks, Abhishek, and thanks everyone for joining, and thanks for the opportunity. I think in the beginning of this year, we did realize, in fact, more like in December, we did realize that this is going to be a bit of a volatile year. Our view is that this is a year of two halves, or I would say one fourth and three fourth. We expect the first quarter to be quite bad of the calendar year, which is Jan, Feb, March, from a market return standpoint. But the second 9 month period, or the nine bucket that we call, which is from April all the way to December, looks reasonably much better than the first quarter itself. And I'll kind of get into details why that is so. One is what we are seeing right now is obviously spending has been slower. I think you've listened to all of that narrative, but let me still repeat it. Government spend has been down 12%, state is down 8%, power demand, electricity consumption growth, GST collection, corporate tax collection, all of them are in single digit versus double digit in the past 4 years. To that extent, GDP growth has also come off. And to that extent, obviously RBI liquidity was fairly tight before the recent OMOs. And that has obviously, impacted the earnings growth as far as India is concerned. At this point of time, we are seeing an earnings growth of roughly in the range of about 4 to 5%. For mid cap, for large caps, for mid cap about 6 to 7%, and for small cap about 6 to 7%. Now, these numbers, which are at 4 to 6% range in terms of earnings growth, if you look at the last 4 years, for Nifty was about 22%, for mid cap and small cap was about 36 and 49% respectively. So this is a meaningful deceleration versus what we had seen in the last 4 years, right? Technically. Now, how are we going to play the cycle? It looks like the first 3 months will be quite challenging. It's obviously started with a quite challenging note. We expect mid cap and small cap to be to underperform the large caps in the near term. What do I mean by that? It means that if Nifty is going to fall by 10%, mid cap and large cap will fall more than 10%. Now, more than 10 is a very bad way of saying it can be 15, 20, 99, it can be any number, right? But our sense is that the mid caps and small caps will see some correction. We are seeing a small bounce right now, which is happening in the last 2 days thanks to budget, and post budget also we generally tend to see 2-3 days of rub off effect of that. So they say 1st of Feb is Saturday, 3rd Feb is Monday, Tuesday. So roughly about 5th of Feb is where this narrative of budget really is very, very strongly being discounted by the markets, by FIs, DIs, all of them. And post 5th of Jan, I think the reality comes. 5th of Feb, the reality will come back again, right? Is how we really look at from a near-term standpoint. So I think our focus at this point of time clearly is to move away from small caps and hide in large caps, right? At this point in time, you will also see meaningful increase in cash levels. We've been extremely defensive as far as our portfolio construction is concerned. Now, while I want to, give you a slightly more, what I'm giving is slightly more concerning picture from a country standpoint, but I still want to tell you one thing very clearly, that this fall is the last opportunity for you to get into markets. Because the next 9 months, which I was talking about, the base effect is very, very low. Please remember last year government went into election, there is a code of conduct, nothing happens in code of conduct. And after the government came into power, it took some time for the cabinet to come into picture, some time for the momentum to start building up again. So the first 6 months of the government, which is effectively April to October, was a washout month effectively from a government standpoint. Versus this year, on that YOY growth will look very, very strong. So you have to be fully invested in market before 31st of March. Right? Now, one can time it to the best of ability, which I don't recommend, but we trying to time it because obviously we are into day-to-day business of looking at multiple data points and then making a quick view about it. But the way we look at it is we will go all in March. We have fully decided that we will go all in March. We will go down, run down as low as 0.5%, 1% as far as cash levels are concerned, right? But in that level, we will be meaningfully conservative, try to protect every single penny that we can, is broadly how we're looking at markets. So that's how it is a tale of, for 1 quarter and then the 3/4 of the next quarter. Moving to the budget part of it, I think it looks like government really needs to do something on the consumption side, on the middle class side, because that's where there's real pinch of inflation, which is hurted in a meaningful fashion, whether it's MSME or whether it is consumer in the middle class on a small or the lower middle class category. I think there definitely will be something, in my opinion, to really give the relief. Now, is it going to be good enough for the relief, or is it just going to be optics? We have to see. Apart from that, frankly speaking, I think it is going to be a non-event budget, largely. I don't expect any meaningful changes, to happen in the budget. In fact, if you look at the last budget, the government did say that they will come out with a new tax code, and there'll be meaningful changes in the taxation part of it. But the reason I believe it might not be fully reflective in this budget is because the person who was in charge of doing that has become the RBI governor of India. So that's the only reason I believe that, because he was not there in the last 1.5 months, who else would have filled his shoes overnight to get the work done for the government of India as far as this budget is concerned. So you never know, maybe the government would have pulled it up. But I think this is a budget largely focused on taxation for me, and largely focused on middle class. Those are the two line items that I will really watch out for. I think fiscal deficit and all that is under control. There's no doubt about it. So that's not a surprise element any which ways. But I think the two things that I really want to look out for is, what relief they go to middle class in the form of taxation, and if there is any meaningful changes that they're doing on the taxation side of it. Capital gains, I think they've clarified last time, if I'm not wrong, that they will not tinker. So that's great news. And hence, I think, effectively these two become the major line items, from a medium to longer term standpoint. So that's broadly, I think, what we look at the budget from a budgetal standpoint. I think these are the few things that I can think of. Coming to portfolios, I think before getting into portfolios, I want to take a few minutes to speak on Kalyan. I think there has been a lot of rumors moving around in the marketplace. And I think some of those rumors would have got squashed completely today. Kalyan was a 15%. People thought that they will make a big inventory write-off. That is the rumor where it started in this quarter, where auditor will give a qualification. And then there was income tax raid and all those rumors. I think all of those rumors have been incorrect, and the stock is rebounded after a very strong results yesterday. And there were meaningful amount of rumors about us as a house and other houses as well. In our opinion, I can't speak about other houses, but as far as our house is concerned, there has been absolutely nothing. We have come out with a press release in the past 1 week that there's been no SEBI inquiry, SEBI search, no income tax search, none of that sort. Business as usual. And there's also rumors about redemption. We have seen no redemption. Even today, we are seeing net inflows. And this month, January, which is just closing today, has been the second best month for us in our history in terms of inflows. So that's a brief about Kalyan. Moving to portfolios. Mid cap. Let me give you some sense on how mid cap is positioned today. We have seen about 7% kind of underperformance in Jan. Of that, about 3.5 is only coming from Kalyan in a meaningful fashion, which is one stock impacting us meaningfully. Some of that reversal has already happened today. We do expect that reversal to continue as we go into early part of Feb. But we believe whatever we've lost, we will be able to recover broadly by March end. I would say large part of it will be recovered March end, and hopefully we should move back in the right direction. We believe whatever we've lost plus 4-5% more alpha is what we are now budgeting to at least get it done by September of this year. Right. So by September end, you will see from our usual highs plus 4-5%. At least that is how what is our internal target. Whether we'll be able to achieve or no is anyone's guess. But that's a tall task that we've kind of made for ourselves. Uh, so mid caps is in a reasonably strong position. The good thing about mid cap fund, if you look at our top 5-6 holdings, you would have actually seen extremely strong earnings growth, right? And this is the only thing that we focus in house. That whatever stocks that you have in a portfolio, and specifically the larger ones where the weights are quite large, you need to
Right.
have very very strong earnings growth, and earnings upgrade cycle. You look at some of the names that we have in a portfolio, you would have seen all of them having absolutely phenomenal earnings growth, at least an earnings beat of anywhere between 5 to 20% in that bucket. And we have seen meaningful earnings upgrade for all the stocks in our portfolio at a time where the market has seen meaningful downgrades on stocks, right? So that would give you some kind of comfort from a portfolio standpoint. Similarly for Flexi, it's important to keep in mind that Flexi has little more mix of mid and small. And you would see now in the current fact sheet that we have tilted that mix more towards large. And I think in the next 1 or 2 weeks we'll complete that exercise. And post that, you will see a lot of stability coming to Flexi Cap, right? From a return standpoint. And again, Flexi kind of got impacted because of Kalyan. Again, 300 basis point impact because of Kalyan. But I think we again do believe the same way, right? For Flexi, we will be back to new highs plus 3 or 4% extra by September of this month. So that's broadly where we are on Flexi Cap. So mid and Flexi have covered. Business cycle, I think off to a great start. Kind of took a little bit of a setback because some of our small cap stocks kind of got corrected a bit. We strongly believe business cycle is actually in a phenomenal position at this point in time. Because the earnings growth of all the companies in business cycle is actually surprised us in a meaningful fashion. In fact, within all our portfolios, the maximum earnings upgrade actually come in business cycle fund. And some of them are yet to report results, right? Some of the large ones from an allocation standpoint are yet to report results. And we will see how the earnings growth really shapes up for them. But even in business cycle, you will see a movement from mid-small, I would say largely small to large, at least for the next 2-3 month period. So to summarize, I think in totality, we are moving away from small caps into large caps, trying to protect alpha, trying to be a little more conservative for the next 2 months, and an appropriate time. And there is enough and more evidence in the past that we change our gears very rapidly. So from a first gear, we'll go to fifth gear directly without putting the second, third, and fourth gear. And we have a full work done which stocks we want to buy from now all the way to September. In fact, at this point in time, we are now working on next year's themes or next year's stock ideas, which we believe we need to start working on. So it looks like for the year, we are broadly well positioned. In the next 6-7 days, I would say that all the portfolios will be absolutely phenomenally poised for alpha generation from February onwards. So whatever has happened in Jan because of Kalyan, I think that's behind us, and you will only start seeing meaningful recovery going forward. Yeah.
So it was like you covered all in single go. I'll take some pause and I'll ask you to just talk about firstly how are you looking ahead the FI traction way forward, because whatever seen we in January or probably December, November, it's all one-sided and all negative. So I think they would have already sold more than 2 lakh crores by now. And so what's the way forward? Why or when you expect them to come back? How important are they in this journey of ours? And lastly, because of probably Trump and its own way how the US economy or the largest economy of the world is behaving, is that or probably the depreciation for them in terms of rupee terms is a little more higher. That's why they are moving away, because now we are almost like 20% cheaper for them. So, but
Correct.
still they're not coming here. So your views
Yes.
on
Yeah. So I think if you look at last year, FI did sold the number is 2.5, 3 lakh crore, whatever the number is last year for the full calendar year. But if you look at an aggregate, I think it's very quite important to look at the data in aggregate rather than looking in a myopic way. Last year, in fact, the net FI outflows were only $700 million. Okay. between 600 and 700 million dollars. I don't recollect the exact number. So the reason why is that FI was selling in secondary market and participating in the primary market, right? Which is IPOs, blocks, QIPs, all of that, right? So they sold in the secondary market. They participate disproportionately in the primary market, which is blocks and all. And hence, I think FIs did quite a smart job last year, right? Which is not visible in day-to-day data. What is day-to-day data available? Day-to-day data is like evening a flash on CNBC. FI sold 7,000 crores, 6,000 crores, but no one talks about the primary market because that's quite difficult to get captured on a day-to-day basis. So if you take that into consideration, the net sell by FI last year was only 600 to 700 million dollars. We believe this year is also going to be a similar number, right? While we have seen more selling in the first half, we do expect meaningful buying coming in the second half of the year.
Okay. So second half, as in you expect them to come probably after Q1.
Yes, of calendar year. After April.
Yeah, Q1 of the calendar year or probably Q4 of this financial year. Post the earnings or whatever they expect from the earnings are out by this quarter. So Niket, so though you have covered quickly across the flexi cap and multi cap, can you share some sectors or some change of positions which you have made? Because I believe you have converted some of the funds into cash and you are sitting on cash also. So what are the top holdings which you have changed over the period? Top holdings or sectors?
Yeah, what we have done is in this kind of month, and I can specify the name of the stock because the fact sheet is not out, but
It's okay,
very briefly is that we've tried a level best to deconcentrate the portfolio at the first place, reduce the concentration in the portfolio because we have meaningful gains in each one of them. The second thing that we have also made an attempt in this month is to start moving in a rapid fashion towards large cap and away from mid and small caps. Having said that, some of our mid and small caps have done extremely well for us, right? There's not been any concern whatsoever in most of our mid and small cap names, right? So they've done extremely well for us. No complaints at all as far as the performance of the mid and small cap is concerned. But we do expect that for now we want to move more towards the large cap and just want to hide for some time. So there is cash, there is large cap, enough and more cushion to the portfolio. If the market goes down, we will protect our NAV. The fundamental focus, which you see across all portfolios, is that from growing the NAV, we're now trying to move towards protecting the NAV. And at some point of time, we will very rapidly move from protecting the NAV back to growing the NAV. And that's what we have been up to in the last, I would say, 6, 7, 8 days, 10 days. And another 6, 7 days, we'll broadly complete that exercise. So by Feb, you will start seeing meaningful traction to the portfolios. You will suddenly start seeing that our portfolio is not correcting. Market is going down, we are not going down. All of that. Market is going up, we are fully participating in that performance. But our first focus is to protect the downfall. So moving to sectors, I think IT, pharma, consumer, telecom, manufacturing. Within manufacturing, wires and cables. I think these are the 5 sectors that we continue to focus and continue to like. Rest all, we've generally been avoiding it. And we generally want to avoid it as we kind of go forward. And we do believe that there is enough and more, I would say, opportunities in the marketplace available today for us to really make the most of the stock picking abilities that we have. So whether it is large cap, mid cap, and small cap, eyes are open, ears are open. If we get something, we'll not shy away to invest. But given where our positioning is, we will be more towards large cap, at least for the next 2 months. Just on the repeating on the sector part of it, I think IT, telecom, pharma, consumer, and manufacturing, and within manufacturing, wires and cables. At the same time, it appears that defense is getting into a bottoming out situation in the next 2 months, right? So we do believe we will look at defense. Not a meaningful allocation, but small allocation to defense is definitely on the cards in the next 2-3 months. And I do believe that defense will definitely going to make a big bounce back in this year, which I do believe it's probably going to be the last leg of the rally for defense, given the order book and given how export opportunity is going to play out with the new president coming up. On the other side, what we don't have banks. We continue to remain negative on banks just because of low growth. Credit growth in the economy is about 10-11%, 10.6 to be precise. still are in a slightly more deficit kind of situation. Obviously, RBI has taken some right steps in the right direction. All these benefits will take 2 or 3 quarters to really play out in the economy. It doesn't happen overnight. And hence, to that extent, we do believe earnings growth of banks will only start moving up in a couple of quarters from now. At the same time, we also want RBI to cut rates, which means NIMs of banks will be under more pressure because 40-50% of the loan book is linked to repo. And overnight cutting of rates immediately reduces yields for banks. And hence, we believe that earnings growth for banks will continue to remain weaker this year. And for next year, we do believe banks will make a comeback. But this year is something that we will try to time our movement into banks again. Is broadly how we are really looking at the broader picture as such. So banks, we would continue to stay away. Power, we've stayed away. Renewables, I think, is probably the biggest bubble. So we're exiting renewables everywhere. And what else? Yeah, power we've stayed away. Metals, we've stayed away. So all of them, we generally continue to keep it away. From an allocation standpoint. So broadly, focusing on these 4-5 themes which I just articulated, because the growth in all those themes is about 20-25% structural, in spite of being macro, in spite of the weakening macro environment.
Got it. Got it. So I'll tell all the investors who are there or listening, because what Niket was referring, I'll just give him some pause and I'll talk for a while. When we are saying we are giving some comfort to the portfolio, probably or saving on the NAV, I'll just tell our investors NAV as of yesterday was around 95. NAV as last year, same time was 73. Last to last year was 49 or 50 rupees. This is for mid cap fund. So from 50 to 95, that's the journey which we have seen. And the peak which we saw was 113 or 114 somewhere. So if as an investor, you yourself are tracking your portfolio and seeing your own positions or portfolio getting changed on the direct stocks, probably this is what fund management is trying to bring on the table, is probably a more stability, less volatility on the overall portfolio side. And just to tell all the investors, because Nikita, here over the call, we have mix of audience who have joined, probably somebody who's already invested, somebody who's planning to, and somebody who is relatively new. So just to tell you, NAV or NAV of mutual fund is not specific to any timing. So if I'll say what I'm saying is there are funds like HDFC Flexi Cap funds spent 30 years. Now the NAV is 1800. There is Nippon fund, NAV is 3700. Though the stock peak is something different, these funds keeps on changing the stock. So you actually one doesn't have to see when he's entering it is on the top or it's at the bottom. Primarily what you have to see is the fund manager, is the fund philosophy is good, are they doing the right justice to the portfolio, are their allocations are correct, and are they able to create alpha over a period of time than the benchmark, then you are hitting the nail. And what we from HDFC try to add to it is our own research and our own recommendation. So two funds which Niket manages, which is HDFC Flexi Cap and HDFC Mid Cap, both are part of our recommendation, and one should look into it. HDFC Flexi, MOSL Flexi Cap Fund, I'll also tell the NAV history. I think it was currently it's around 56. It went to 65. Last year, same time, it was 45, and last to last year, it was 31. So this is just to tell the investors that yes, the funds are progressing. You should remain invested. You should add more, I believe. With adding more, Niket, what is your thought? People should add in this lump sum looking at the correction, or you still prefer a staggered way of putting into money, fresh money?
I think it's quite difficult to time the market, and I think one should not try to do that. And hence, I would say between now and March 31st, you should put in a staggered format. If someone wants to really take a little more risk, then I think go all in March. But that's a very risky strategy.
Right, right. So all in March, probably I think our house view is also you should go in staggered. So probably a 6-month high value SIPs can definitely make you feel much more comfortable where or to place your bets. In fact, staggering over 6 months is a decent, or an STP for next next 3 to 6 months, or whatever is the best approach. Also, Niket, we have seen a great success for a very short time, say, so to say, because in business cycle we started with September and we are just in Jan, 4 months. So NAV is though plus, still the broader market is down. But how do you differentiate between the three funds? Because you're managing the three different funds, and so it can be constituted as it's a similar portfolio. The NAV will move in a similar fashion. Can you throw some light on that?
No, so I think you know all the three funds are quite different from a mandate standpoint. But what happens is that all the best ideas that we generally get, we try to accommodate in all the funds, right? So whether it was their food delivery business in the past, which was present across all our schemes, or whether it was telecom businesses that we invested, whether it's mid cap IT that we have invested, you would see a lot of commonality in our highest conviction ideas or the best ideas of the house, replicated across whatever schemes at best we can, right? And that's clearly the endeavor to do it, right? Where all the schemes tend to benefit at the same level, right? The second thing that we also tend to do is all the small caps, because of the larger size of the mid cap fund now, our focus has been little more on small caps in the multi cap and the business cycle fund. So business cycle and multi cap is typically vehicles which are very smaller in size. It's easy to get some of the best small cap ideas up and running very, very fast for us. So I think that's the only two differentiation which I would think of when I look at multi cap, flexi, and mid and business cycle funds.
Okay. Niket, I think this November or December you launched a new fund which was on technology, and now you have another fund which is on innovation. So can you throw some light on it? What is the difference? Because it felt to us, is it a replica or what it is? So 2 minutes on it.
Yes. So I think in November you would have seen a digital fund, and obviously it's done quite well in the last 3 months or 2 months duration. Again, early days, but yeah, it's kind of come out pretty well. Having said that, if you look at a new innovation fund that we're launching, and the NF was already started 29th of this month, it's all about identifying companies who are going to disrupt the existing incumbents, right? So let me give an example. If you look at the auto sector, the EV is different, disrupting the IC guy. So whosoever is a disruptor is also an innovator. Without innovation, you can't disrupt. So essentially, this fund will be focusing on guys who are going to be on EV. Similarly, within banking, say Paytm is some sort of disruptor. In the payment space, so again, that becomes an area of allocation. Food delivery is a disruptor to restaurant business. So while it's an innovation fund, you can also go to a disruptor fund, whichever we want to look at it. But the only difference between the digital fund and this fund is the innovation fund cuts across all sectors. Digital fund only is focused on tech related digital part of the business, and very less outside the non-tech part of it. This is across the board, across every line item, every sector. Wherever there's disruption, this fund will be really looking at allocating capital. So if you look at all sectors around us today, there's disruption happening, whether it's pharma, IT, banks, everywhere there's disruption. This fund will essentially focus on those stocks which are disrupting. And because they're disrupting the existing guys, they're also by design growing at a faster pace than the industry growth, right? Which also solves for our QGLP philosophy, where we focus a lot on growth. So that is how we would really classify both of them.
So we have talked whatever so far is all good about the way forward. What are the three things, Niket, which you believe can definitely derail? Because I remember last time when we spoke, we were bullish about December being a great month, but it didn't turn out. So what do you believe could be the three things which can derail, or three, four things?
Yeah. So I think one thing which is that the economy is moving at fairly rapid pace. So it deteriorates quite quickly and the revival is also quite sharper in some months. And in the last 4 years, we've not seen that trend. But off late in the last 6 months, we've seen that trend. So October, November was very strong. December is very bad. Jan is very bad. I don't know about Feb and March, but it looks like Jan has been on a weak start. But again, in some sectors, Jan has been okay. In some sectors, it's been weaker. So you have to, there's too many data which keeps changing quite rapidly because the economy is also going through like an oscillation kind of a mode, right? Which generally is not good, from a growth standpoint, because no one likes volatility in businesses, right? So I think earnings growth is one big risk, which I tend to see. The second risk I think is uh, I'm kind of slightly more disappointed the way Trump has really come in, kind of not acted on tax cuts, or he's mellowed down his voice on China, which I think he'll not do anything on China this cycle, because he has an advisor called Elon Musk, which has a large capacity in China. But that's my personal view, that I think Trump will not take on China this time, because China is also much better prepared than last cycle. But I think he can definitely take on Mexico or Canada, which are a little more easier markets to take on, which obviously benefits China in a meaningful fashion, in some sense. If there's a 25% duty on Mexico and Canada, the first biggest beneficiary is China, and then second is India. So I think we have to keep that in mind. So that's, I think, the second risk that I see. US not doing meaningfully well in this cycle, in spite of Trump being around. But this time it's not Trump alone. Trump has a set of advisors. Whenever you have a set of advisors in life, you only tend to make decisions which are not out of your gut feel. And Trump generally, in Trump 1.0, was just all over the place. Like whatever he said, kept doing it for the country. And thankfully, country responded in a great fashion. Jobs loss were quite low. Unemployment is record low. Growth was at record high. Great economic environment when Trump 1.0. But I think this time it's going to be slightly more different. So I think some negative surprise from US can also come in, which is 10-year earnings growth in US. By the way, US market is extremely polarized at this point in time. Only a few stocks are doing well. Rest of the parts of the stocks are not doing well. So I do believe that this is a, in some sense, early days, but it looks like a return of China. China will make a comeback, and I'm also seeing a lot of Indian government guys trying to or trying to move one step forward with China, and trying to bridge relationships again, which is also visible in the visa data. The visa given to Chinese nationals is at a 7-year high. So I think we are seeing a lot of data points where it makes us believe that China might come back in game. And again, it's a cycle kind of a thing. But looks like the advantage of India will continue to remain at a global scale. So that, I think, is a second important point to keep in mind for us. Yeah, I think these are the two things which I would really more bothered about: US data points and Indian earnings growth. That's it.
So whenever we are talking about investing, there are two things which Indians always have a love towards is fixed deposits and gold. I don't want a larger view, but anyways, do you believe there will be a rate cut, or what's your house view on the rate cut? Just a number and nothing on that.
Yeah, it looks like RBI wants to do a cut. But if you look at logically, RBI would find it difficult to do a cut. For the simple reason is the inflation is still quite high.
Right.
Food inflation is up 9%. Look, when you start giving 2 lakh crores of freebies to the lower strata of the income society, typically those people, the first thing, if you give a 4,000 rupee to a Ladli Ben or whatever, Ladle Bhai, Jijaji, whatever it is, if you give a 4,000 rupee gift in his bank account, the first thing that a person does is have very good food rather than wearing good clothes and home. घर तो ले नहीं सकते 4,000 रुपए में, कपड़े तो आएंगे नहीं 4,000 रुपए में, तो खाना ही खा लेते हैं ढंग का. तो food inflation is real, and the problem with food inflation is never comes down, right? My wife keeps telling me that tomatoes is X, potato is Y. It has not come down in the last 10 years, right? So that's an inflation check at the house, but it just doesn't come down. So it's quite stickier. So my sense is that RBI might not cut rates in this cycle. It will wait for another one, maybe in the next one, but looks like it will not do in this one.
And what about gold? Any
Gold, I continue to remain bullish. I think the simple reason is China continues to buy gold, right? And when the dragon is in the same direction, why take the opposite direction given the size that they buy at? The second important thing on gold is the US has also said that they want to increase the duty on gold for gold coming in the country. So, but that by design, gold becomes expensive at global scale. If the duty is 3% goes to 5%, it moves up by 2% extra, right? So I am quite optimistic about gold. I think gold is heading towards anywhere between 85, close to 90,000 rupees to from an INR standpoint. But then I think it will consolidate. There is going to be demand destruction at 90,000 for sure. As far as consumers are concerned. At this point in time, we are not seeing. In fact, in Jan also we saw a reasonable amount of growth in jewelry space because of very strong wedding season. And if there is any tax cut on customs that the government announces tomorrow, which makes gold even more cheaper, there will be another round of rush from that standpoint on jewelry businesses. But having said that, I think gold is in a right business, right spot. The important thing to keep in mind as investors in India is gold has actually given very strong returns to investors over the last 6 months to 1 year period from a return standpoint. Anyone who's invested in gold is actually sitting at a 52-week high in some sense. But in stocks, it's not a 52-week high. So a customer thinks that if I get another 100 rupees, which I'm saved, should I buy gold or should I put in equities? But design it goes to gold because gold is done quite well. And I think it will continue to do well, at least for the first half of this year. I don't know about the second half, but it looks like stars are all aligned for the first half of this year for gold to do quite well. And when demand destruction happens, then we will see. But it looks like another 10% rally for sure.
Right. I think we have come to end our discussion. All our investors who have joined us, please note HDFC Securities Research has we have our own understanding and own learning across the funds which are available in the market, and basis that we choose couple of funds which we believe really goes apt for investors. So all those who are looking to take very aggressive bets, we still recommend Motilal mid cap fund to be part of your portfolio. It has done great, but that's not the reason why we say you should buy, because that's history. But yes, we believe the way the portfolio is positioned, and it should continue to give you rewards for the money which you invest. And similarly, relatively less aggressive, but definitely it's an equity. So obviously, I can't say it is less aggressive, but relative to mid cap, I was saying that Motilal Flexi Cap Fund is one thing which you can look in for if you are looking at for a large cap or a larger diversified portfolio, I should say, with relatively a lesser volatility. But having what we are looking at, the markets, things are really difficult. So please do invest for long term. Don't think about probably a month or 6 months or 1 year, because things can definitely go either ways. We are bullish on the Indian economy and all, but we have seen there are pauses which are beyond the controls of. So please look in for long term. And most importantly, if you actually, my senses or my advice to all the investors who are not too savvy to it is, please have a goal. And if your goal is 5 years, just it's like fill it, shut it, forget it kind of an approach which one should take. So like if I am as an investor in 2022, I have invested in, say, a flexi cap, or currently the mid cap of, say, Motilal itself. It was at 45 rupees NAV, it is 95. I should be happy. But if the day I start looking at daily, I get the hit. But if I see year on year, trust me, and I'm not saying for one fund, it could be across the group. So all the fund managers are doing the beautiful job of managing the portfolio, and they know what to keep, what not to keep, at times which stock to exit, which is overvalued, undervalued, what FIs are not buying, or which make really good sense to buy. So leave it up to them, and because anyways our lives are very complex, so let the one complexity to the fund managers to take care of. And thank you, and wishing a great budget tomorrow. And thanks, Niket, for taking our time.
Thank you, Abhishek. Thanks everyone.
Thank you, everyone. Thank you. एक्शन ही नहीं हो रहा है